Good afternoon, everybody, and thanks for registering for our webinar this morning. We're going to speak about personal financial planning in the context of yesterday's budget and also in the context of the current market environment and the economic situation that we find ourselves in. Many of you know me. My name is Jonathan Sheehan and I'm Managing Director of Compass Private Wealth. I'm joined by two of my colleagues, Robert Smith and Zara McDonald.
Hi, I'm Robert Smith. I'm a portfolio manager here at Compass Private Wealth.
Hi, I'm Zara McDonald. I'm a financial advisor at Compass Wealth, and I'm looking forward to working with you all over the coming weeks and months.
Thank you, Zara. So what I'll do is I'll firstly just go through the housekeeping and agenda. So starting off, you've met Robert and Zara. Many of you know me. There are other points of contact within Compass if you have any inquiries or queries after today's presentation. We will be recording this. It's me who is being recorded rather than you. So we will send out the recording afterwards. We'll also send out the slides. There is a Q&A button within Zoom, so please do put questions throughout the webinar, and myself and Robert and Zara will take the slides off at the end and go through any questions you have. Now, in terms of the agenda, yesterday's budget has been widely covered already in media circles. There hasn't been much in terms of changes in a context of financial planning and wealth management. There may be more detail in the Finance Bill or the Finance Act. So for now, what we'll do is we'll discuss a high-level overview of what happened and what was said yesterday in the budget. But then I'll speak about the 8 pillars of financial planning and wealth management. And I'll discuss how the wider economic and market environment is impacting on personal wealth and financial planning. So there will be budget-specific points, but frankly, I will be speaking more about the current inflationary environment and the volatile world that we're living in, more so even than the budget. And as I said at the end, at about maybe 35 minutes past 3, we'll open up for Q&A. But do put questions throughout the webinar, and I'll endeavour to answer them as I go or else at the end. So what I'll first do is I'll show you our website. So we have a specific page on our website, compassprivatewealth.ie/budget 2023. And just to run through some of the points, the first thing that was discussed was by Pascal Donoghue was the rate of inflation. Now we know that inflation in Ireland officially hit 9.1% last month and it cooled to 8.5% this month. So what they're predicting is that by December, we'll have seen the inflation rate will still be at about 8.5%. But if you consider that inflation really kicked off in April or May of last year, prices are about 12 or 14% higher now than they were then. But on an annualized basis, they're saying it's about 8.5%. 7% in 2023, 7% is still a big number off a higher base. But what that is telling us is that the government are predicting we're moving into an environment of disinflation, not deflation, but disinflation, where you're still inflating, but at a lower rate. We know that the Irish economy is still robust, but there are challenges ahead. And what they're saying is that domestic demand is forecast to be just over 1% next year. Unemployment is close to all-time lows at the moment in Ireland. That is expected to be relatively low. And the government surplus is expected to be about £1 billion this year. We know that there was one-off incomes from corporation tax that may not be that predictable in the future. So that has helped Ireland certainly this year. So just a few general measures, okay? There's the excise reductions in petrol and diesel have been extended. The 9% VAT rate on hospitality looks like it's been extended, but actually hasn't been. What they've said is that from the 1st of March onwards, 9% will default back to 13.5%. VAT on newspapers down to 0. The small benefit exemption, that's of interest to business owners here or accountants, tax advisors here or speaking to their clients, that €500 voucher scheme has now increased to €1,000. And I understand that's in place from this year. A student grant of €1,000, a vacant home tax coming in, which will really incentivize people to get land to work, which will be at about 3 times the prevailing LPT, local property tax rate. To help out those renting, there'll be an annual rent tax credit of €500 for each of the next 3 years. Help to Buy scheme has been extended. Pre-letting expenses, again, have been increased, and the 12 months to 6 months. So what they're trying to do there is they're trying to incentivize people to get property, residential property, to work as much as possible. So in terms of income tax, on income, there's 2 types of income. As you know, there's earned income, which is your employment income, and there's passive income. From a financial planning point of view, the key is to move from earned income to passive income in retirement, and to build up enough of a capital base to churn off sufficient passive income to fund your retirement. So the rates in Ireland are the same. There's no differentiation really between earned income and passive income, other than, say, the employee tax credit. So there has been some increases in terms of the standard rate cutoff. It's gone to 40,000. I think it's up to 80,000 for a couple both working. That's the rate at which your income kicks into the 40% rate from 20%. Tax credits have increased. USC band has increased ever so slightly as well. As you know, Compass doesn't advise on tax. We let all the clever accountants and tax advisors who work with us to advise. Where we really see traction from our perspective is on pensions and investments. So starting with pensions, the full state pension has increased, okay, but it's only increased a very, very small amount. One would have expected to, you know, in the context of all the other increases and the inflation environment and the energy crisis, but because the state pension age is staying at 66, it just means that I wouldn't foresee the same level of annual increases as if the state pension had been at 67 or 68 or 69. So that's just one thing to be mindful of for pre-retirement people on this webinar, and that the current state pension amount isn't likely to increase as much as we would like because they've kept it at 66. There will be a one-off pension payment as well, a double payment in the state pension as well in the coming months. There'll be 3 €200 electricity credits, double child benefit, the public transport reduction fare, which is great when you're coming in from Portmarnock and the Dart every day to the office. Importantly, with things like a budget, it's also what hasn't been mentioned. So there's been no mention of any change in the 2 million fund threshold for pensions, 200 grand lump sum, or the tax relief on contributions. For companies, there's been 2 big schemes pledged for struggling businesses. The KEEP and the SARP have been retained as well. So they're the high-level tax measures. There's a hell of a lot more on the public expenditure side, and cigarettes and fuel and different things like that. But I suppose the purpose of this, from a financial planning point of view, is for us in Compass Private Wealth to give you a holistic picture on what matters from a financial planning point of view. So what I'm now going to go through is the 8 pillars of holistic wealth management. And frankly, there wasn't too much in the budget yesterday that will have a dramatic impact in terms of wealth management and financial planning, but there is a lot going on in the market or in the economy at the moment that is relevant. So I will speak about them in the context of what's happening at the moment. So the 8 pillars, the first one is retirement planning. We also need to make sure your asset allocation, so not investing per se, but how your assets are allocated across different entities, across different asset classes, geographies, sectors, that type of thing. Tax and cost efficiency is very important. So tax and fees should be considered in every financial decision one makes. Risk management, that's very relevant at all times in any financial plan. Financial education, somebody said to me recently, how is that a pillar? Financial education overarches all of the other points. But it's just very, very important at all times to be up to speed on what's happening with economics, with markets, with asset classes. Because if there's one thing that I've learned in this industry for the last 15 or 20 years is that nothing ever remains the same. There's always going to be a challenge. So being educated, hopefully clients of ours would see that we do pass on as much as possible in terms of knowledge and informative webinars like this. So the next point then is investment selection. So within the context of asset allocation, well, how do you populate your pension portfolio or your investment portfolio in light of the budget or in light of the prevailing market environment? Cash flow planning is probably the most important pillar in the context of the current market environment, when we're seeing huge inflationary pressures and a dent to asset prices, therefore future income streams being reduced somewhat. So we will speak about cash flow planning later on. And finally, succession planning. So when you look at your assets, you could look at them in three different compartments. One is the assets you have until retirement, the assets you have to fund your retirement, and then if there's surplus to your requirements, then what is your succession plan? How are those assets going to be passed on to the next generation? Have you written a will? Do you have enduring power of attorney in place? What type of considerations have you made in terms of tax minimization, passing assets on your lifetime, that type of thing? And what I've shown here really is how each of the 8 pillars are intertwined. So you can't make a decision in isolation. You can't just say, I'll be great on the financial education side. I'll read the books, I'll attend all these webinars, read everything that every fund manager sends to me. But you have to put things into action. Equally, if you just focused on your retirement and that's all you cared about, or you could be putting too much into your pension and not paying down debt, or you could be running a cash flow deficit, or if you just focus on succession planning. So I think the point is that you really need to look at wealth management in the context of all 8 pillars. And at any one point in time, understand that any decision you make in one aspect will have a knock-on impact on another. So asset allocation to start with. So the format of each slide is, on the left side, I'm going to speak about what I call timeless planning philosophies. And on the other side, we'll discuss what the impact of either the budget or the current economic environment has. So firstly, on the left here, at all times, one has to have a rainy day fund, a nest egg, and we call that a minimum cash amount. And that can be the post office or it can be in cash. So that's the starting point with any asset allocation strategy. You also need to be aware of risk and return. So all else being equal, the higher the risk you take on, the higher the potential return. The lower the risk, the lower the potential return. So you need to ensure that the risk that you have across your overall portfolio, and I'm not speaking about a stockbroker portfolio you have or a pension portfolio you have, I'm talking about the big picture, all aspects of wealth management. And everything needs to be looked at holistically as well. So we also need to look at increased interest rates. That's very important at the moment in asset allocation. So it's changed the dynamic of asset classes. We also need to look at, we need to understand that no asset class is safe. That's very, very important. We have this feeling like, oh, cash is safe, bonds are safe. But if you're in an inflationary world where prices are rising by 9% per annum, and your cash is earning nothing, then you are really losing 9% on an annual basis in purchasing power. And we have to expect and anticipate volatility. Okay, so now we're on to tax and cost efficiency. So the timeless points here really are that fees, unnecessary fees, are inversely correlated with annual net performance. So if you're paying 2% per annum in fees and your gross return is 4%, then your net return is 2%. Now, if you can have the exact same portfolio and you're close to 1%, then you've got a 3% net return rather than a 2%. So 1.5 times higher. So avoiding unnecessary fees, and in my opinion, avoiding complexity, because complexity equals fees. And sometimes investment firms are guilty of complicating things too much and loading on unnecessary fees. Tax minimization in everything you do. Again, lots of clever tax advisors out there can advise you in this regard. If you minimize your tax, you're minimizing your net, you're maximizing your net return. So I suppose it's still the case in Ireland that certain fees and costs are offsettable. So for example, if you're investing in a portfolio, you want to make sure that the fees that are incurred come from within the fund as much as possible, so that by default they're tax deductible. If you've got a property, an investment property, you want to make sure that the costs associated with that property are offsettable within it, and 100% of the costs of, say, an investment property can be written off. That had been, I think, 75% a few years ago, and they brought it back up to 100%. Also, pensions are the most tax efficient as well. So, so we also have pensions continue to be the most tax efficient, and in terms of fees, they are more they are the most competitive. Ireland has become a lot more competitive over the last few years. Risk management. So what we're speaking about here really is it's so important at all times to protect your downside and keep your options open and remain nimble. Again, people who are on this call who have more years, I suppose, in this world than I have seen a lot more. But if you look back over history and what happened in the oil crisis and what happened in inflation in the 80s and .com and the global financial crisis, Eurozone crisis, where we are at the moment, we have to expect the unexpected, unfortunately. And what we're going through at the moment with Russia, Ukraine, and inflation, that will pass. You have to understand that that will pass, and there will be something else in 2 or 3 or 4 years again. And what I've kind of made the point here is that at the moment, we saw what happened in the last week with the UK and political decisions that have been made there. I might be unfair to say political decisions. I guess there's decisions the UK government have made for in their opinion, the benefit of the UK people, but it's been interpreted very negatively by markets ultimately. And that's out of the control of all of the UK individuals, taxpayers over there. We have to be mindful in Ireland that a change of policy or a change of government in Ireland can generally, at the moment, would not be looking good for wealth management, because there is ultimately an agenda there potentially to go after larger assets and larger incomes. So that's something from a risk management perspective we have to be very, very mindful of also. Then we'll look at financial education, and I'll just be brief on this one. Look, knowledge is power. The more you know, the better the financial decisions. Hopefully our role is to work with clients and be that knowledge box as much as possible. It's also important to avoid the noise, so that there's certain things happening in stock markets at the moment, for example, that are completely unpredictable and out of my control, out of your control, out of everybody's control. So we think that by avoiding the noise and the stress and the intraday movements of stock markets, that's just so important in terms of understanding the big picture. So in the current environment, having full transparency of your existing financial affairs is so important. So really, we're in that time of year, back to school, where we should really be rolling up our sleeves and understanding, okay, what exactly is my overall balance sheet? What is my cash flow situation? Looking into 2023, everybody here should know what their cash flow situation is going to be, because your outgoings are probably going to be about 20% higher, probably about 30% higher than they were in 2020, because we were all at home in 2020, and probably 15 or 20% higher than they were in 2019, because of inflation, because the cost of everything is going up. So it's so important to educate yourself, receive education in terms of what is your financial plan, what is your budget, what is your capital base. In terms of investment selection, so again, we've spoken about asset allocation, which is the high level decision. But then once you go to populate the different pieces of the pie in terms of asset allocation, how do you do that? The first is diversification. Always, regardless of the market environment, being diversified is so important. The next point is the longer your time horizon, the better your chances. Okay, so if you said, I'm investing X amount of money in this idea or this fund or this asset class, and in 12 months' time, I'm going to need my money back. Well, in the current environment, your chances are probably 50-50 in any asset class on a 12-month basis. Even on a 24, 36-month basis, you've probably got 55-60% chance of winning out. But if you have a 20-year time horizon or even a 10-year time horizon, you will have 2 or 3 negative years, but 7 or 8 positive years will see through that. So that's what's so important at all times, is have a long-term time horizon and be mindful of liquidity as well. So don't put money into things that you can't, that you may need money back from, that you may need liquidity for. So in the current environment, bonds have now become an investable asset class again. What that means is that the bond yields now have gone from -1% to +2% or 3% or even 4% in some cases, because with the interest rate cycle, the yield on bonds increased significantly. So now the yields are here. So actually investing in a 10-year government bond isn't as bad an idea as it was, a year or 2 years ago when interest rates were so low. So bonds are coming back into the mix now. Deposit rates will increase. We have to remember in Ireland, because of KBC and Ulster Bank leaving, there's very little competition there. So the likes of AIB and Bank of Ireland will wait until, frankly, political pressure probably comes on them before they start increasing deposit rates. So you'll see a big time lag between inflation, interest rates on loans, and interest rates on deposits will always lag. So even when we get the best deposit rates for our clients, you're always going to be slightly below inflation. And the current environment, you're obviously significantly below. Unfortunately, there's no end to the continued volatility in equities. This morning, at 6:30 in the morning, things were looking very negative. Asia overnight, futures in the markets today. Markets opened up heavily down this morning. And then as of an hour ago, US markets were positive. Europe was recovering because of a bond buying program in the UK. So you have to understand that volatility in the current environment is going to continue. One point to just be mindful of is that with residential property in Ireland, with the rent pressure zones, as you know, you're capped at a 2% increase in terms of how much rent can increase. That does make property, physical property, a less attractive asset class in the context of inflation is running at 9%. And even if we go by the government predictions of 6 or 7% next year, your income is only ever going to increase by a maximum of 2%. So it does make that decision about investing in residential property more difficult. From our perspective, when we're advising clients, I think residential property was a lot more of an investable asset class for individuals 10, 15, 20 years ago. Now it's become so compliant, it's more or less been removed as an option for pensions because of IRPS 2 regulations. So, we do have discussions with clients in terms of property is important as part of a portfolio, but just to make sure that you're aware that you are capped at 2%, so you will lose out on the inflation at 8 or 9% versus the 2%. In terms of the budget, yesterday there's no change to capital gains tax at 33%, no change to dirt or exit tax or anything like that. Cash flow planning. Okay, so what is timeless? Okay, everybody here, everybody in the world, every year, at the end of every year, has either run a cash flow surplus or a cash flow deficit. Same with every business, same with everybody. Okay, accountants here will understand this better. Okay, so there's nothing wrong with running a deficit if you have sufficient capital built up. So if you're 75 and you're retired and you're running a deficit of 50,000 per annum, but you've got multiples of that in liquid assets and pensions, that's absolutely fine. If you're running a surplus and you're in your 40s, you might think, oh, it's great in running a surplus. But if you're only running a surplus of 10,000 per annum and you need multiples and multiples of that to retire at your chosen target retirement age, then potentially you're in trouble. So understanding and having a target cash flow surplus or deficit is very, very important. And the point I'm trying to make here from a timeless point of view is that the deficit isn't necessarily bad and a surplus isn't necessarily good. It's the amount of it and the amount of capital you have. So if you've got a negligible capital position and you're running a surplus, you know, sometimes our advice actually is that you shouldn't run a surplus. You should always be cash flow neutral. So you have a certain amount in nest egg in the bank. Okay, that's your rainy day fund. And if you are running a big surplus, then the surplus should be maxing into your pension, should be going to a monthly savings account or whatever it is. Because actually running too much of a surplus is inefficient because you want that money to be working for you, going back into the market so that you can build up your capital in years to come. So at the moment, we've seen big inflationary pressures, okay? So we're aware of the statistics there. So there's a huge cost in the cost of living. So when you're doing your cash flow planning, that's income less outgoings. Your outgoings now are going to be a lot higher. The second bullet point I have here is that you need to personalize it to you. So when we look at the CSO data, it says it's up 8% or 9.1%, 8.5%. But what is your inflation rate? So I might say statistically there was no inflation in Ireland for 13 years up until last year. But if you said that to somebody who's trying to get on the property ladder or someone trying to rent, they wouldn't agree with that. If someone is living in an A-rated apartment in the city centre, their energy bills, who doesn't have a car, who walks into Google or Facebook or somewhere every day, they mightn't see much at all because they don't have any personal energy costs because they're not driving. They mightn't be traveling long distance. In fact, if they're getting public transport, they're paying a bit less. The cost of a lot of things like on Amazon and technology, all that actually hasn't moved too much. But if you're living in the countryside in a D-rated house with a big garden and a big house to heat, and you're having to drive an hour to work every day, you're potentially seeing a 30% inflation rate. So it's also, you know, as I said earlier, there are certain reliefs and measures that have assisted out in the cash flows from a cash flow planning point of view, but frankly, it's a drop in the ocean. We all have to understand that next year, this year, it's going to cost us more to live if we want to keep doing the same things that we've been doing. From a financial planning point of view, sometimes when we sit down with the client and actually go through the nuts and bolts of the spreadsheet, we do have a very good spreadsheet that we can send on to you if you like it, just a budget template spreadsheet. But you know, if you categorize your outgoings into essentials and discretionary, you know, it's quite easy sometimes to cut a bit of fat off the discretionary to bring your cash flow position positive again. And it might be one less holiday a year, whatever it is, or holding back and buying the car or the extension of the house. But there is scope to do that in most cases. Succession planning. So what's timeless? Put on your own life jacket first. It's all well and good giving kids or grandchildren money in your lifetime, but you want to make sure that you and or your partner or spouse have enough capital for your lifetime. Because once you give it away, it's hard to ask for it back. Compartmentalize assets for your lifetime and the next, and be tax efficient to avoid intergenerational erosion of capital. In terms of succession planning, there is no change to the parent to child threshold, the parent to grandchild or sibling, which is Group B, or the Group C threshold. So there was nothing announced anyway yesterday. You never know, these things could be brought up in the finance bill or in future budgets, depends on who is in government. The small gift exemption actually was rumoured to be going up from 3,000. That didn't happen, it's still at 3,000. That's a great way of passing funds on to the next generation, because husband and wife, 3 kids, kids are married, there's 6 people below them. And if the 3 kids have 2 kids each, there's actually 12 people below them in the family chain. And those 12 people can receive a total of 6,000 from husband and wife. So actually, if one did have surplus capital, you can give 72,000 per annum in that case on to the next generation very tax efficiently. Best way to do that is just set up an investment account for them and put it directly in there rather than actually transferring money directly to them, because sometimes that can cause issues within families. Finally, retirement planning. You have to remember, the good news is that we are living longer. So we need more capital if we want to retire at 65. We might now be living well into our 90s, whereas 65, 30, 40 years ago, that person was expected to live into their late 70s, maybe early 80s. So we're living longer, so retirement planning is becoming more important. Always, as I said earlier, compartmentalize assets, and please, you have to do the cash flow budget. It's so important. It's more difficult than a capital budget. A capital is easy. You tot up the value of your assets, take away your liabilities. Looks great. We can give you all the lovely pie charts, all that. Cash flow budget is more difficult because you need to sit down with your partner or your family or whatever it might be and say, what are we spending our money on? What is this costing us? What's that costing us? What can we do? So it's very important to do that. As I said earlier, the state pension remains at 66. We will be moving to the total contribution system. And one thing that I really, really welcome is that people pre-retirement will actually start getting an annual statement, and there'll be more transparency about saying, well, how many stamps or PRSI credits do I have built up? So for example, someone taking time out of the workforce or who's worked overseas, will be great in a couple of years, hopefully, for someone who's 58 to be able to see, I've got 37 of the 40 years done for the full. And if I retire now, I get 37 40th. That level of transparency is coming. And in fairness, there's a lot of hard work around there. So that's great. And again, there's been no changes to private pensions. Standard fund threshold is the same. Tax reliefs are all the same. And tax-free growth in pensions is the same. So I'm just about on time at the 35 minutes. So if anybody has any questions, I'd be delighted to take them. So one question here is, what is the core inflation and what's the core inflation expected to be and how does that affect us? Okay, so the CSO website is actually very good. The CSO website breaks down exactly where the 8.5% rate of inflation comes from, and it splits it out into different sectors. So obviously what's going on with Russia and Ukraine and gas and oil, I think the last time I checked, the rate of inflation, say on energy, is about 26%. The rate of inflation, education and technology and things might be 1 or 2%. So the CSO is actually the best source of information in relation to that. Next question here in relation to the employee, the €500. Yeah, so what that is that for business owners here, for staff and or part-time staff and full-time staff, is that you can buy them a voucher and up to €1,000, and that €1,000 can be gifted to them, and it doesn't go through payroll, and it's not a taxable gift. So I guess it's a way of rewarding staff on the one hand, and also making sure that you're giving them 500 more that would have been taxable at 52% in some cases. So it's giving those who are being hit with being hit with increased cost of living more wiggle room. Next question here. New players into the pensions market, will it make a difference? And I'll deal with this question actually in the context of what I said earlier about competition. So Royal London are, obviously a lot of people will be aware of Royal London, and they have always just done protection in Ireland, and they just launched pensions products this week, just ARFs and just buyout bonds. And yes, it make a big difference in terms of competition, because recently Aviva bought Friends First. That took one player out of the market, and Royal London are coming in quite competitive. When it comes to portfolio management, in terms of what you get when you're investing money, hopefully you'll all invest your money through Compass Private Wealth, but when one is investing, you need a custodian. That custodian physically holds your assets, and they deal with things like settlements and transactions and reporting. So you always need a good quality custodian. I would have concerns using a low-cost broker, online broker, unless you're putting 500 euros into the market for a bit of fun. For large amounts of assets, you know, I'd be quite nervous using online brokers. So you need a custodian, you need a fund platform or investment platform, and you need advice to go with that. So I suppose there's a lot of different structures for custodians in the market. The pension providers like the Royal London coming in, and the different stockbrokers and the private banks. What you don't want to do is pay different layers of fees on top of each other. So you want to make sure that it's all rolled up within one to make so as tax efficient as possible. Next question here, is cash a good asset class at the moment for someone close to retirement? If you're 2 to 3 years to retirement and you need your capital, you have no other option other than cash. Because if you invest in anything other than cash, it could fall by 15 or 20% in the next 2 years. Now, bonds may not fall by that much in such a short space of time, but certainly cash would have to be an option for the majority of your asset base in that case. With risk, there's 3 ways of looking at risk. There's your appetite to risk. So someone who'll jaywalk or someone who'll double park, they might have a high appetite to risk, and they might say in a fact-find form, oh, I have a high appetite to risk. But you also need to look at your capacity for risk and your tolerance of risk. So someone might be very, very risk averse, but they might have huge capacity for risk if they've got a big, massive lump sum of capital that they don't need. So you can say, yeah, you have low risk appetite, but you have a high capacity for risk and potentially a high tolerance for risk. So it's always important when you're looking at risk to look at those 3. So I'm just conscious of time. We're coming in just time. I'd like to thank everybody for joining us today. We got in just within the 40 minutes, I'm delighted to say. On behalf of my colleagues Zara and Robert, thanks to all of you for attending. We will send out the recording in due course and the slides, and feel free to reach out to any of us in due course with any questions. Thank you very much.